Welcome to the deep dive. Today, we're digging into a real classic, Benjamin Graham's The Intelligent Investor.
A foundational text.
Exactly. And don't let the original publication date fool you. This revised edition, it's got loads of modern commentary, making it super relevant for, figuring out today's markets.
That's right. It really bridges the gap. You get Graham's original wisdom plus analysis that connects it all to, well, right now.
So our mission in this deep dive, we want to pull out those key principles, the core ideas from Graham that can help you, the listener, become a more informed, more, intelligent investor.
Yeah, basically cut through all that Wall Street noise and focus on what actually works, based on decades of experience and analysis.
Okay, so let's start at the beginning. Graham's early career. It sounds like he learned some tough lessons pretty quickly on Wall Street.
Oh, absolutely. I mean, one really stark example was Savile Tire back in 1919.
Savile Tire.
Yeah, he saw the stock just explode, like 250% on day one. Huge excitement. But then, just months later, the whole thing collapsed. Turned out it was a complete fraud.
Ouch. So boom and bust right from the start.
Exactly. It really drove home for him that crucial difference between just, speculating, chasing hot tips, and doing actual sound investing.
That must have made a huge impression. It sounds like it pushed him towards more careful research.
It definitely did. Fast forward a few years, 1925, and you see that research pay off big time with Northern Pipeline Co.
Northern Pipeline. What was the story there?
Well, he dug into the details, stuff most people just glossed over, and he found the company was sitting on this huge pile of high-quality bonds.
Hidden assets, basically.
Pretty much. Way more value than the stock price reflected. So he invested, actually pushed them to pay out more to shareholders, and made a significant profit. It's a great illustration of his method. Thorough analysis uncovers value.
Okay, so that experience, and others like it, led him to define what an investment actually is. What was his definition? It was quite specific, wasn't it?
Very specific. He said an investment operation is, quote, one which upon thorough analysis promises safety of principal and an adequate return.
Right. Let's break that down. Thorough analysis.
That means you've really done your homework. You understand the business, its finances, its prospects. No shortcuts.
Okay. Then safety of principal. That sounds key.
It's paramount. Your first job is not to lose money, or at least not to risk serious losses. Protection first.
And finally, adequate return. Not extraordinary, just adequate.
Exactly. Aiming for reasonable, satisfactory results, not shooting for the moon with crazy risks. So it's analysis, safety, and reasonable expectations. That's the core.
So right from the start, he wasn't really into what we'd call stock trading, chasing quick profits.
No, not really. He generally viewed trading as not meeting his definition of investment. It often lacked that deep analysis and, crucially, that focus on protecting your initial capital. It felt more like speculation to him.
Makes sense. I mean, picking winning stocks consistently is incredibly hard, isn't it?
It really is. And Graham saw a couple of big reasons why. First, well, we're human. We have biases. We get emotional fear and greed kick in. That clouds judgment.
Definitely.
And second, markets are often pretty efficient. The current price usually reflects what everyone expects to happen. So finding those truly undervalued gems, it takes serious work. It's not just lying there in plain sight usually.
Yeah, you hear about these systems, these strategies that are supposed to guarantee success on Wall Street. O'Shaughnessy's stuff or the January effect. What did Graham think of those?
He was pretty skeptical. He observed that, yeah, sometimes a strategy works for a while, but as soon as it becomes widely known, everyone piles in.
And the edge disappears.
Exactly. The advantage gets competed away, and then you've got trading costs on top of that, which can easily wipe out any small gains you might have made. So these magic formulas, they rarely stay magic for long.
Okay, so what about market timing? The classic buy low, sell high. Simple in theory.
Simple in theory, incredibly difficult in practice. Graham definitely saw trying to time the market as speculation, not investing. Even really smart, experienced investors struggle to do it consistently.
So the takeaway is don't even try.
Pretty much. Focus on what you can control. Your research, understanding the value of what you're buying, your own reactions, and your long-term plan. Don't try to predict the unpredictable swings.
This leads nicely into his idea of two different types of investors, the defensive and the enterprising. Can you unpack that for us?
Sure. Yeah, he saw these as two main paths. First, there's the defensive, Or you could call them the passive investor.
Okay, what's their goal?
Their main priorities are safety and, frankly, freedom from worry. They want to preserve their capital and not spend a lot of time or mental energy on their investments.
So they accept maybe a lower return for less stress and less risk.
Exactly. It's about ease, safety, minimizing effort, and decision-making. Think steady, conservative, maybe less exciting, but hopefully reliable.
And then the flip side, the enterprising investor.
Right. This is the active investor. They're willing to put in significant time and effort doing research, analyzing specific stocks or situations, trying to find those opportunities for potentially higher return.
But it comes with more risk.
Potentially, yes. And Graham was very clear. This path demands more. It requires, proper training, good judgment, emotional discipline, and really keeping an eye on costs. It's not for everyone.
So it's not like one is better than the other.
Not at all. He stressed that both approaches can work very well if they match your personality, your knowledge level, and if you stick to the chosen strategy consistently. Control your costs, control your emotions, that's key for both.
And he made that interesting point that risk isn't just in the stocks, it's also in the investor.
Yes. A really crucial insight. Financial risk isn't just about market volatility, it's also about you. Are you likely to panic sell? Do you overestimate your own skill? Understanding yourself is just as important as understanding the market.
Okay, let's dig into the defensive investor's playbook. What kind of portfolio did Graham suggest for them?
Well, the absolute cornerstone for the defensive investor is asset allocation. How you split your money between different types of assets.
And his suggestion was?
Back then, his classic recommendation was a simple 50-50 split. Half in high-quality bonds, half in a diversified portfolio of common stocks.
50-50. Seems balanced. Why include stocks at all if safety is the main goal? Bonds seem safer.
They generally are, in terms of price stability. But Graham recognized that over the long haul, stocks offered better protection against inflation eroding your purchasing power. Bonds might preserve your nominal capital, but stocks had a better chance of growing it in real terms. Even if it wasn't guaranteed, you needed that potential.
So, stocks for inflation protection. Got it. And he warned against trying to tweak that 50-50 based on market moods. Or borrowing to invest.
Absolutely. He strongly advised against using margin borrowing to buy securities. Too risky for a defensive investor. And he cautioned against drastically changing your allocation, like going all into stocks when the market's high or all into bonds when it's low. Stick to your predetermined split, rebalance periodically, but don't make big bets based on market noise.
What about consistently adding money? Like dollar cost averaging?
Yeah.
Putting the same amount every month.
Yeah, he was generally in favor of continuing existing dollar cost averaging plans. It imposes discipline. However, he did add a note of caution, using late 1964 as an example, suggesting that maybe you shouldn't start a brand new averaging plan if the market seemed really, really high.
So maintain discipline, but maybe pause new commitments at potential peaks.
Kind of. It shows even a systematic approach requires some judgment about extreme market conditions. But for an ongoing plan, keep it going.
Okay. And on the bond side of that 50-50, what should a defensive investor look for in bonds?
Two main things. First, consider taxes. Depending on your tax bracket, tax-free municipal bonds might give you a better after-tax return than taxable corporate bonds, even if the initial yield looks lower. He showed an example from '72 illustrating that.
Right. Depends on your personal situation.
Exactly. Second, credit quality. This was non-negotiable for Graham. Stick to high-grade bonds. He specified ratings like AAA, AA, or A from the main agencies like Moody's or S&P. The goal is safety of principal, remember? So avoid risky, low-rated bonds.
Did he mention other income-type securities, like preferred stocks?
He touched on them, yeah. He noted that sometimes the market seemed biased against things like income bonds, even when they had certain advantages for the issuing company. He felt that wasn't always logical.
And preferred stocks.
He didn't see a huge advantage for the individual defensive investor there, compared to high-quality bonds or common stocks. They're kind of a hybrid, and didn't offer compelling enough benefits in his view for this type of investor. The message was, keep it simple and high quality.
What about growth stocks? Everyone loves a growth stock. Surely defensive investors could dabble.
Graham was pretty firm on this. Generally, no. He saw growth stocks as inherently more speculative and uncertain.
Why? Because the future is hard to predict?
Precisely. You're paying a high price today based on expectations of future growth. If that growth doesn't materialize or even just slows down, the stock price can get crushed. He knew picking the right growth stocks and knowing when to sell was extremely difficult, especially for someone aiming for safety and low effort.
Yeah, the commentary mentions examples like Microsoft and Cisco having huge drops later on.
Right. Even great companies can become drastically overpriced and then suffer huge declines. For the defensive investor, the potential reward wasn't worth that level of risk and uncertainty. Prioritize stability.
So for Graham, risk wasn't just the stock price bouncing around day to day.
Not at all. For a real investor, the real risk was, 1, the possibility of a permanent loss of your capital because the company itself deteriorates fundamentally, or 2, the risk of paying far too much for even a good company, meaning your returns suffer for years, maybe forever. It's about the underlying business value versus the price paid.
It's fascinating how relevant that still feels. How does this defensive approach look today, given how low bond yields have been at times?
That's a great point, and the updated commentary by Jason Zweig tackles it head-on. He notes that in the early 2000s, with bond yields so low, even a defensive investor probably needed some stock exposure just to have a fighting chance of beating inflation and meeting their goals.
So maybe not strictly 50-50 anymore.
The principle of balance remains, but the exact ratio might shift based on prevailing conditions. And the modern recommendation, it leans heavily towards diversification through low-cost index funds.
Index funds. Makes sense for a defensive approach.
Totally. Get broad exposure to the whole U.S. market, maybe some international stocks, some bonds, all through low-cost funds. Combine that with automatic, regular investments, and you've got a very sensible, low-maintenance defensive strategy for today's world.
Okay, let's switch over to the enterprising investor, the active one. Where did Graham suggest they look for those potentially better returns?
Well, the enterprising investor's job is to actively search for value for situations the market is mispricing. Graham famously talked about finding bargain issues.
Bargain issues, like what specifically?
One classic category he focused on was stocks selling below their net working capital or net current asset value.
What does that mean exactly?
Basically, you take the company's current assets, cash, receivables, inventory, and subtract all its liabilities, including long-term debt, if the stock price per share is less than that number.
You're essentially buying the current assets for less than they're worth and getting the buildings, equipment, brand, everything else for free.
That's the idea. It sounds unbelievable, but Graham found quite a few of these back in his day. He did a study in 1957, not even a particularly cheap market overall, and found around 150 stocks meeting that criteria.
Wow. But there had to be a catch, right? Were these all solid companies?
Not necessarily, and Graham cautioned against buying blindly just based on that metric. He stressed you still needed to look for reasonable earnings stability and a decent financial position. You don't want a company that's burning through its working capital rapidly on its way to bankruptcy.
So it's a starting point for research, not an automatic buy signal.
Exactly. Deep analysis is still required, even for these apparent nets, as they're sometimes called.
He also talked about hidden value, didn't he? Like that Northern Pacific Railway example.
Right. That's another angle for the enterprising investor. Sometimes a company's true value is obscured by accounting conventions, or maybe it has valuable assets not fully reflected on the balance sheet, or the market is just pessimistic about its industry for some reason.
Like the low dividend payout depressing the stock price in that railway case.
Precisely. An enterprising investor willing to dig into the weeds, understand the specific situation, could spot that mispricing and potentially profit from it.
What about new stock offerings, IPOs? Especially during bull markets when there are tons of them. Good hunting ground for the enterprising.
Graham's advice was actually the opposite. Be extremely wary.
Really? Why?
He observed that during market booms, many IPOs are brought out precisely because it's easy to sell shares at high prices. Often these are lower quality companies, maybe speculative ventures, capitalizing on the hype.
And they often don't end well for investors who buy in.
Very often, no. He saw a historical pattern. IPO booms are frequently followed by busts, where many of those newly public companies see their stock prices collapse. Think about the South Sea bubble way back when, or the dot-com bubble more recently. The promise of easy money in IPOs is often just that, a promise. He urged caution when excitement is high.
Okay, now for maybe Graham's most famous idea. Mr. Market. This is such a brilliant concept. Can you explain it?
It really is genius. So, Graham asks you to imagine you own a share in a private business, and you have this partner named Mr. Market.
Okay.
Every day, Mr. Market shows up and tells you what he thinks your share is worth. And crucially, he offers to either buy your share from you at that price or sell you his share at the same price.
So he's always willing to trade.
Always. The thing is, Mr. Market is, Well, he's a bit manic depressive. Some days he's incredibly optimistic, sees only blue skies ahead, and quotes a ridiculously high price.
Hmm.
Other days he's consumed by pessimism, convinced everything's going to pot, and he'll offer to sell you his share, or buy yours, at a desperately low price. He also doesn't mind if you ignore him completely.
Right, he just shows up every day with an offer driven by his mood swings.
Exactly. Sometimes his price seems fair, reflecting the actual value of the business, but often it's way off, driven purely by his emotions, his enthusiasm, or his despair.
So how should the intelligent investor deal with this emotional partner?
The key is to see Mr. Market not as a guide, but as an opportunity. You don't let his mood dictate yours. Instead, you use his irrationality to your advantage.
No.
When Mr. Market is deeply pessimistic and offering you shares at a bargain price, far below what your own analysis suggests the business is worth, you should consider buying from him.
Take advantage of his gloom.
Precisely. And when he's wildly optimistic and offers you a price far above intrinsic value, you might consider selling to him. But importantly, you are under no obligation to trade with him at all. If his price doesn't make sense to you, you just ignore him and wait for a better offer another day.
So the market's fluctuations are there to be exploited, not feared or followed blindly.
That's the core insight. You use the market price only when it serves your purpose, when it offers a bargain purchase or an attractive sale. Otherwise, you focus on the underlying value of your holdings, not Mr. Market's daily pronouncements.
Did Graham contrast this sensible approach with how, say, professional money managers often operate?
He did. He pointed out, somewhat critically, that many institutional investors often end up behaving just like Mr. Market. They feel pressure to be active, to follow the crowd.
Herd behavior.
Yeah. Buying when stocks are popular and expensive, selling when they're out of favor and cheap. Basically doing the opposite of what the Mr. Market allegory suggests. He also noted that managing huge pools of money creates constraints.
How so?
Well, it limits their flexibility. They often end up concentrating on the same large, well-known stocks, which can become overpriced, partly because everyone owns them. It's harder for a giant fund to nimbly take advantage of small mispricings the way an individual investor potentially could.
So the individual investor actually has some advantages.
Definitely. Freedom from institutional pressures, the ability to think independently, and crucially, the ability to be patient and truly long-term oriented, ignoring Mr. Market's daily noise.
It sounds like patience and independence were really central for Graham.
Absolutely critical. He talked about needing an investment owner's contract with yourself. It's basically a commitment to your long-term strategy. You define your goals, your approach, and you stick to it, resisting those emotional urges to chop and change based on market whims or news headlines.
Because frequent trading usually hurts returns.
Yes. He observed that all that activity generates costs, commissions, taxes, and often leads to worse results than patiently holding well-chosen investments. He famously quipped that maybe long-term investor is redundant. It's the only kind of investor there truly is. The rest is speculation.
Okay, let's shift focus a bit to selecting investments through funds, like mutual funds. What were Graham's thoughts there? Did he trust professional fund managers?
He was cautious. One key observation was that strong past performance in mutual funds often didn't persist.
So picking last year's winner isn't a great strategy.
Generally not, no. He saw that hot funds tended to cool off. What worked in one period often didn't work in the next. Relying solely on past returns was unreliable.
Did fund size matter in his view?
Yes. He highlighted that as funds get really large, it can become a drag on performance.
Why is that?
Bigger funds face higher trading costs. Buying or selling large blocks of stock can move the price against them, and it's just harder for them to find enough genuinely undervalued opportunities to make a meaningful impact on a huge portfolio. Their universe of potential investments shrinks.
So if you can't rely on past performance, and size can be a negative, what should an intelligent investor focus on when picking a fund?
Expenses. This was crucial for Graham, and the updated commentary really doubles down on this.
Costs are key.
Absolutely. Low expenses should be your first filter. Graham provided some benchmarks back then for what reasonable annual operating expenses looked like for different fund types, like bonds or U.S. stocks. Those costs come directly out of your return year after year, so minimizing them is paramount.
So filter by low cost first, then look at strategy, risk, and potential return.
Exactly. Get the low-cost universe, then start comparing the funds within that group based on other factors. He also warned against just blindly following recommendations from brokers or financial firms.
Do your own homework.
Always. Understand the fund's philosophy, its holdings, make sure it aligns with your goals. Don't just take someone else's word for it.
What if you want help? What about choosing a financial advisor? Any tips there from Graham?
The core message was about trust and transparency. Find someone demonstrably honest. Understand exactly how they get paid. Are they earning commissions on products they sell you? Or are they charging a fee based on your assets or for advice?
Alignment of interests is key.
Crucial. Get recommendations, verify their credentials, understand their fee structure inside and out, make sure they're working for you.
Okay, let's talk about security analysis itself, digging into stocks and bonds. Graham differentiated this from broader financial analysis, right?
Yes. For him, security analysis was specifically about evaluating the merits and value of individual stocks and bonds. Financial analysis was broader, including security analysis, but also encompassing things like overall investment policy, that asset allocation decision we talked about, and analyzing the bigger economic picture.
He seemed a bit skeptical about overly complex mathematical models for valuation.
He pointed out a kind of paradox. These really sophisticated mathematical valuation methods often get used most heavily where they're arguably least reliable, namely with high-growth stocks.
Why least reliable there?
Because those valuations depend almost entirely on forecasting future earnings far out into the distance. And forecasting the future is, well, notoriously difficult and prone to overly optimistic assumptions. The math looks precise, but the inputs are often highly uncertain speculation.
Makes sense. So for safer ground, like analyzing bonds, what did he focus on?
Safety tests, primarily things like earnings coverage ratios. How many times over can the company's earnings cover its interest payments?
A buffer, basically.
Exactly. You want to see a comfortable margin of safety there, assurance that the company can easily meet its debt obligations. He used the Penn Central bankruptcy as a cautionary tale, a seemingly solid company whose declining earnings coverage was a huge red flag that got ignored by many.
And for common stocks, what was the ideal analysis, even if difficult?
The goal was to determine a company's intrinsic value.
Its true worth.
Right, which involves estimating its likely future average earnings power over several years, and then applying a suitable capitalization factor or multiple to those earnings to get a present value.
Yeah.
But again, he stressed the difficulties.
Like with reported earnings figures. They aren't always straightforward.
No, definitely not. He highlighted issues like potential dilution from stock options, which can reduce the value accruing to existing shareholders, and the prevalence of special charges or one-off write-offs that companies sometimes use, which can make it hard to discern the true ongoing profitability.
So you need to look deeper than the headline number.
Absolutely. Analyze the financial statements carefully. Look for consistent profitability over time, financial stability, not too much debt, reasonable growth, but be very wary of just chasing high growth rates without considering the price you're paying, the PE ratio. High growth is great, but not at any price.
The book uses several case histories to drive these points home. Why include those detailed stories?
They're incredibly powerful teaching tools. Cases like AAA Enterprises, franchising hype, Penn Central, the railroad collapse, Ling Temco Vought, a conglomerate built on debt, and then the more modern examples like Lucent, Tyco, AOL, Time Warner, eToys from the bubble era.
What do they illustrate?
They show in very concrete terms the dangers of speculation over investment, the absolute necessity of financial strength and manageable debt, the risks of expanding too quickly or too aggressively, and just how irrational market valuations can become during bubbles. They make the principles real.
Were there comparisons, like good versus bad examples?
Yes, the contrast between a stable real estate investment trust and the reckless realty equities core showed different paths. He also hit on how goodwill on the balance sheet after mergers can be illusory if the acquisition price was way too high, based on hype rather than substance.
And even how company names or imagery can affect perceptions.
Right. The funny examples comparing Cisco, tech darling, versus Cisco, food distributor, or Yahoo versus Yum Brands, it highlights how easily investors can be swayed by superficial factors or emotional associations rather than focusing on the underlying business fundamentals. Don't invest in a story, invest in a business.
Okay, one last major area Graham covered was the relationship between shareholders and the companies they own, specifically management. What was his take?
He really felt shareholders needed to be more engaged, more like active owners, not just passive ticket holders. They should hold management accountable.
When is it justified to question management?
He suggested a few triggers. Persistently poor results, especially compared to similar companies in the same industry, and a stock price that remains depressed for a long time without good reason. If the managers aren't delivering, shareholders should speak up.
What about dividends? How did he view those?
He generally saw dividends as a tangible way for shareholders to receive their share of the company's profits. He noted even back then a trend away from special one-off dividends. While he acknowledged the academic debate about whether dividend policy even matters theoretically.
The Miller-Modigliani theory.
Right. In practice, he thought shareholders had a right to expect a reasonable payout if the company was consistently profitable and didn't have genuinely better uses for the cash internally.
And how could shareholders make their voices heard?
Voting against directors who aren't performing, attending shareholder meetings, though he knew that was often impractical, using whatever forums were available. He also strongly advocated for truly independent directors on boards to provide unbiased oversight of management.
He also mentioned companies hoarding cash.
Yes, the issue of companies building up huge cash piles on their balance sheets, think Oracle, Cisco, Microsoft later on. He questioned whether holding excessive cash indefinitely was always in shareholders' best interests.
Better to return it.
Often, yes. Either through dividends or share buybacks, though he noted CEOs might sometimes favor buybacks for reasons related to stock options, not necessarily maximizing shareholder value. The point was, don't let cash just sit there earning low returns if there aren't compelling reinvestment opportunities. He saw a potential gap between corporate asset growth and real growth in shareholder value, which led back to
the margin of safety.
Exactly, this central concept.
Okay, let's make sure we fully grasp this. The margin of safety. How did Graham define it technically?
Technically, especially later in his career, he often framed it as the difference between the earnings yield on a stock, that's the earnings per share divided by the stock price, and the interest rate you could get on a safe bond.
So how much more return are you potentially getting from the stock's earnings compared to a bond to compensate for the extra risk?
That's the idea. It's your cushion, your buffer against errors in your valuation, unexpected bad news, or just general uncertainty. If a stock's earnings yield is, say, 8% and high-grade bonds yield 4%, you have a 4% margin of safety.
And he pointed out in 1972 that this margin was actually negative for the market overall.
Yes, which was a huge warning sign for him. Stock earnings yields were no higher than bond yields, meaning investors weren't being compensated for taking equity risk. Stocks looked expensive relative to bonds.
He used an example about the cost of loss, too, didn't he? About overpaying.
Right. He showed how if you overpay significantly for an investment, even if it eventually performs well, it can take a very long time just to get back to even, let alone make a satisfactory return. That initial lack of a margin of safety creates a deep hole to climb out of. It highlights why avoiding big losses by not overpaying is so crucial.
And this ties back to his idea that the real risk is often within the investor.
Absolutely. Overpaying happens because you overestimate future prospects, or you get caught up in market euphoria, or you don't understand the business well enough. The margin of safety protects you from your own fallibility, from underestimating risks, from having insufficient tolerance for downturns when they inevitably happen.
He connected it to Pascal's wager. How so?
By pointing out that in investing, the consequences of being wrong can be much more significant than the probability of being wrong might suggest. Losing a large chunk of your capital has a much bigger negative impact than the positive impact of an equivalent gain. So you need that safety margin because the downside of error is potentially catastrophic.
Yeah.
Don't bet the farm without a buffer.
Okay, so wrapping this all up, if you had to distill the core, timeless message of the intelligent investor for someone listening today, what would it be?
I'd say it's this. Intelligent investing isn't about predicting the future or finding secret formulas. It's about discipline. It's about thorough analysis of what you buy, focusing relentlessly on protecting yourself from major losses and aiming for satisfactory, adequate returns over the long term.
And avoiding speculation and herd mentality.
Definitely. It's about being a rational, informed owner of businesses represented by stocks, not just a gambler playing with ticker symbols based on emotion or tips.
And crucially, understanding yourself as an investor.
Paramount. Knowing if you're temperamentally suited to be defensive or enterprising, understanding your own knowledge limits and risk tolerance, and then this is key, sticking consistently to a strategy that fits you. That's the foundation for long-term success.
Great summary. So here's a final thought to leave everyone with, building on Graham's ideas. Think about that Washington Post example from 1973, A great company whose market value was ridiculously low compared to its obvious underlying worth at the time.
A classic value opportunity.
Those kinds of discrepancies between market price and intrinsic business value still happen. Maybe not as extreme, maybe harder to find, but they exist. The challenge and the opportunity for the intelligent investor is to keep learning, keep analyzing, keep thinking critically about value, and always, always demand that margin of safety.
Well said.
Thanks for taking this deep dive with us.